Hey guys, how's it going? It's Andy from MagooInvesting. Happy Monday. Woke up this morning with some really good news about the stock market. There seems to be some positive momentum when it comes to an overall vaccine, and the stock market jumped this morning. I woke up and it's currently up between 2 and 3% depending where you look, and some companies are recovering very well. One of the trades that I made last week with Delta is up around 10% today. So the market is full of optimism right now, and it'll be very interesting to see if that optimism sticks around or it's something that's going to kind of hang around for a couple days, and when we don't hear any more news about this vaccine, that things will continue to fall further. So it's going to be something I'm going to watch this week. In the past couple weeks, I've been talking a lot about undervalued stocks, just because as things fell during the month of March and going into April, people were looking for discounts for companies that they could buy that were going to be fantastic investments for the future. And so everyone's kind of been looking for that for the past couple of months. And during almost the entire month of April and going into May, things have gone very well in the stock market. And when you look at a lot of these major players, Microsoft, Apple, Google, they're all pretty close to even or positive on the year. And so they're not at the discount that we saw a couple months ago. And so I've been looking for undervalued stocks because everyone is wanting to get involved with the stock market, and things are not as cheap as they were a couple months ago. But when you start looking at undervalued stocks, you kind of have to do some due diligence to see, are these companies at a discount and something I should invest in, or are they cheap because no one wants them? And so in today's video, I'm going to be talking about 3 companies that I've identified as having problems with their business that can either be fixed relatively easily or it's something that's completely out of their hands. I'm going to start off the video talking about Best Buy, which I think is a fantastic example of a retail company that people did not have a lot of faith in at the beginning of the 2010s. There was a lot of news articles that I found saying that the company is likely to go bankrupt. And so I want to talk about the problems that were affecting the company and how they bounced back and are now a well-respected company. I think there are plenty of undervalued stocks out there. I recently just took a position in Delta because I had identified the problems that were affecting them and why they're down almost 60% year to date, and saw that it's mainly not their fault at this point, and I think they have the fundamentals and the business model to survive through this. So in this video, we're going to start out with Best Buy, talk about what happened with them, then we're going to be going into the struggling or undervalued stocks, and we're going to start with GameStop, then we're going to go to Walgreens Boots Alliance, and then we're going to finish out the video with Macy's. And so the whole point of this video is I'm not going to be doing any fundamental analysis. That's something that's a pretty complex topic for people that aren't as used to looking at the stock market. But something that almost everyone can do is look at the company and the business that they're running. Just from a couple Google searches, you can have a good understanding of how the company is making most of its money. And if you can identify problems with that and you don't think that it's going to improve in the future, that should be a big enough red flag that you should stay away from the company at all costs. Before we get started, I have to say that I'm not a financial advisor and this is financial advice. This is just me giving my opinions on 3 different companies and how I do analysis on them. If you've been liking these videos, I really appreciate it if you hit that like and subscribe button, as it would help my channel out a lot. With that being said, let's get right into it and talk about Best Buy, ticker symbol BBY. So the problem of me doing research for these videos the night before is everything looks fantastic until the market opens, and we get this massive boost to the stock market with the news that came out this morning. And since then, the company is up 10% compared to when I was doing my research on it. So at this point, Best Buy is trading at around $86 and it's up 10% and means that it's pretty flat on the year. And so when you look at the past 5 years, Best Buy has been it's been outperforming the stock market overall. And it's been one of those companies where when I saw how well they've done in the past couple years, I was pretty surprised. And when you go back at the early 2010s, you see articles talking about people expecting that Best Buy was going to go bankrupt. And what's the main reason behind that? Well, Amazon started taking all of their sales. And this is a problem that you see with a lot of companies that are publicly traded on the stock exchange. Amazon is the big bag giant and they take a lot of customers from other businesses. And so one of the main problems is that people would go into Best Buy, look at the product or try it out, and then go buy it off of Amazon because one, it was probably cheaper and it was probably easier to get it delivered to your house. And so this was a huge problem because people were coming into their stores, trying out their products, but they weren't actually buying anything. And so for a while, people thought that there was no way that Best Buy could fix this. And so when I throw up the all-time chart, you can see how undervalued the company was for a long time. And so you have to step back and think, is this a problem with the overall sector? Is it something that the business can fix? And so when I look at that, the demand for the products are still there. It's not like people are going into Best Buy and not buying anything overall. They're just buying it from somewhere else. So it's something that could be fixed. And the way that the company fixed it is they started doing price matching, which was an incentive for people that are already coming into the stores. Instead of trying it out and then ordering it from Amazon, getting it in a couple days, people were able to go in, try it out, and then buy it for the same amount that they would on Amazon. And this was a game changer for them. And after that happened, the company has recovered incredibly well. At this point, they're even starting to partner with Amazon. And so these used to be 2 fierce competitors, and they've done both incredibly well. And so Best Buy was able to survive the onslaught that comes from Amazon going into your sector. If you're looking at Best Buy back in like 2014, you have to step back and think, what are the problems that are going on with this company? And the main thing is that their competition is kicking their butt. And so the demand for the products are still there. And so if you trust in the management and how the company's been run in the past, you could have some faith that they were going to turn things around, and they absolutely did. I wanted to start out with Best Buy just to talk about companies that looked like they were going towards bankruptcy and they've actually recovered. And so I've invested in companies myself that have not looked very good based off of when you look at the past couple years. But I had faith in the management and having them recover. And so when you look at Best Buy, you can see that it's possible to have fantastic returns buying these beaten down stocks. But that is not the case for every company. So that's why let's go on to our next one and talk about GameStop, ticker symbol GME. At this point, GameStop is up around 6% today, and it's currently trading at around $4.50. And so first time I remember hearing about GameStop stock is when, I think it was around Thanksgiving, around 2 years ago, when they ended up cutting their dividend completely, and that crashed the stock. And I'm pretty sure the price was around $13 at that point. So when I put up the 5-year chart, you can see that the company has been beaten down for a long time. When I put up the all-time chart, you can see that things were pretty good for a while. They had their heyday in the 2010s, and things have started to slide. And so when you look at the overall sector, you see a lot of positives for video games. In the last quarter, they had the record number of sales. It was around $11 billion in total sales in quarter one, which was a 10% increase year over year. And so when you see that type of news associated with video games, and then you look at GameStop, which is only about video games pretty much, you'd expect to see a nice boost in the share price. However, you have not really seen that. And when you start looking under the hood, the main problem is that the main way the GameStop makes money is going away. So from doing a couple Google searches, you can find out that the way the GameStop makes most of their money comes from used sales. And it's kind of been a joke for a long time that you walk into a GameStop, you have like 20 games in your console, and they'll give you $10 for it. The problem is people actually take that deal, and then they flip all of those games and consoles for a lot of money. And now when you start looking at the trend in video games, it's going away from actual physical games. The data that I could last find was from 2018, but as 83% of all game sales were digital, meaning that there is absolutely no way for GameStop to take advantage of this used game market. And so this transition has been kind of pushed by the publishers because they make more money when it's being bought directly from them, and it directly hurts GameStop because there's literally nothing they can do. So when you look at the problems that are associated with GameStop, it's something that's completely out of their control. It is a complete change in the overall sector. It's a transition away from physical games, which is the way that they make most of their money, towards digital. And this is helping the publishers, stuff like Activision that I own shares in, and it's really hurting these retailers like GameStop. So this is kind of how I identified that I'm never going to want to take a position in GameStop. When you looked at Best Buy, the problems that they had was direct competition, and it was something that they were able to fix eventually. When you look at GameStop, I really don't see any way where they can kind of turn this around. The problems associated with them are a change in their business overall. And so their most profitable area is going away completely. That problem of not having physical games and then having too many physical locations, last thing I saw was around 5,500, that kind of pushes me away from ever wanting to invest in the company. So I'd love to know what you guys have to say about GameStop in the comment section down below. All right, next up, let's talk about Walgreens Boots Alliance, ticker symbol WBA. This was a company that I talked about in my Undervalued Stocks to Buy for May video. And so some of the main things that I found out from that video is that Walgreens has been beaten down for the past couple years. I remember talking about them as being the worst performing company in the Dow Jones in 2019. And going into 2020, they're having similar problems. But when I look at some of their problems, I see the possibility that they can recover in the future. Some of the problems that I'm seeing is that they're losing their most profitable area, which is the pharmacy, and it's getting cut from their margin as other areas like Amazon have started to come into the equation. However, the difference with Walgreens compared to something like GameStop is that the reliance on having physical things is what's going to keep Walgreens alive. And so while Amazon can come into the sector, lower the overall price of things, the fact that it has to be delivered, I think takes away from the overall experience. I think there's always going to be a need for corner drugstores to go pick up stuff from the pharmacy. And so while they're having problems right now, if you believe in the management, this is something that can recover in the future. And one of the main things that gives me confidence going forward is seeing that they're a dividend aristocrat, meaning that they've increased their dividend for 25 straight years. It's actually 44, but that's what the cutoff for the aristocrat is. And so seeing 44 years of increase in their dividend shows me that this is a well-run company. It's been around for a long time. And so when you compare that to GameStop, that's only been around for like 20 years and has struggled for most of its lifespan, it gives me a lot more confidence in something like Walgreens because it has the track record of being successful for a long time. And so when you look at the problems with Walgreens, it seems to be a transition away from having the pharmacy be the most important part of their business to they're trying to add to things. And so the more I look at Walgreens, the better I feel for a long-term position. This is something that still has a lot of short-term risk. Things aren't going to get better for the near future, but if you believe in the management and think that this is something that can recover, this is why I think that Walgreens is an undervalued stock, where I think that GameStop is a company that has way too much risk to even consider taking a position in it. And so just looking at these businesses overall, Walgreens has problems, that's for sure. That's why they're down so much. When I throw the all-time chart, you can see that things have been beaten down for a while at this point, but you can see the incredible returns it's had in the past and the 44 years of increasing the dividend. And that's what's pushing me towards thinking Walgreens as being an undervalued stock and not something that has too much risk going forward. Let me know what you guys have to say about Walgreens stock in the comment section down below. And the last company I want to talk about is Macy's, ticker symbol M. Macy's has been a company that has been part of my portfolio just back at the beginning of this year. It was a company that I thought was extremely undervalued, but as things started to go worse in the overall world economy, that's when I cut ties with it. And at this point, it's currently sitting around $5.40, and it's down around 65% year to date. At this point, there seems to be a decent amount of problems that are associated with Macy's. One of the ones that I kind of identified is that they don't really have their own identity. When I look at Nordstrom's, I kind of think about the higher end products, and then the retailers and the department stores that have been doing really well, stuff like Ross, TJ Maxx, Walmart, have been very good at targeting the younger and the cheaper audience. And so they have been fantastic opportunities to invest in the past decade. And so Macy's has continued to slide at this point. When you look at the overall sector for department stores, things have been really tough right now. You have companies like Neiman Marcus, JCPenney just filed for bankruptcy. So you have a lot of problems that are facing the overall sector. And that was one of the main reasons why I invested in Macy's in the beginning, is because things have been tough with the overall sector. And so if I'm going to pick out a diamond in the rough, I want to pick out a company that I think has a lot of staying power. And so that's why I picked Macy's. When you looked at GameStop, the problem is with the overall sector. And so Macy's has the ability to survive this. In the past, they have really succeeded on being the top department store, and now that is kind of going away. And so I've seen some positive numbers about their increases in their online sales. And so when I look at the business, it's something that is hitting the overall sector, and it's something that they can absolutely fix. The longer this goes on, the more curious I'm going to see what happens to Macy's. There's been talks about them going bankrupt for a long time, but they have continued to kind of do all right. They've bottomed out around $4, and in the past couple months, they've just kind of been bouncing around through there. And so while in this video, I definitely like Walgreens the most, I'm going to put Macy's second, just because I think if you're going to pick a company that is in a beaten down sector like department stores, I'm going to pick one that I have personal confidence in. And Macy's is a company like that. So this obviously does not even include any of the fundamentals that could show some horrible things about Macy's. But if you're going to be picking undervalued stocks, you have to have a certain level of confidence with a company. With Walgreens, you have that 44 years of dividend growth. With Macy's, you have a massive brand that I can trust. And that's why I'd also consider them as being undervalued stocks. And so in this video, I just wanted to talk about some of the ways that I look at undervalued companies and see if they have too much risk associated with them to ever consider taking a long-term position. At this point, there are some beaten down companies, and in this video I talked about 3 of them, with Macy's, GameStop, and Walgreens Boots Alliance. And with these companies, I see a variety of problems. You have GameStop, where their overall sector is changing in a way that's not going to favor them in the future. Walgreens has been beaten down just because of being a physical retailer and some of the problems with their most profitable part of their business in the pharmacy, losing some of their margin. And then when you look at Macy's, it's just a problem with the overall department store space. They don't have a really set in stone identity, and so that's a problem facing them in the future. But in the past, I've been focusing a lot on fundamental analysis, and in this video I wanted to show that there's other ways to evaluate companies, and it's not as complex as looking at the numbers. And so I'd love to hear what you guys have to say about this, what you thought about these 3 companies, and talking about Best Buy as a kind of a success story for companies that can recover. I'd love to hear what you guys have to say about this video in the comment section down below. Thanks for watching this video, stay inside, and I'll see you in the next episode.